Hi everybody. So in Europe at least, it's a shortened week this week because of Easter. So we'll have to cram our trading into 4 days. The focus will likely be US earnings, particularly given that the Nasdaq 100 hit a record high last week. The big US tech firms like Amazon, Microsoft and Facebook will take the limelight. Now, as always, we start with the economic calendar. Out of these major data points, I would highlight Aussie CPI, the Bank of Japan, the Bank of Canada, alongside US GDP. On the earnings front, this is one of the busiest weeks for the US corporate calendar. There are some big companies announcing outside the US too, but in just a moment, I'll talk more about these big US tech stocks reporting this week. Now, covering those economic data points, Australian CPI I mentioned, the Aussie dollar actually hit multi-month highs last week, most notably against the yen. That's quite an interesting play because Australia very much a proxy for what's happening in China because so much of the Australian exports go to China. It broke out against the yen, and the yen typically a safe haven. And so given that equity markets are up near record highs, there haven't been much need for haven flows as of late. So the yen has been underperforming. So both the Aussie and the yen, if you like, moving on factors almost outside of those geographical areas. Net result, Aussie yen breaking out of a 3-month range. This Australian data itself, as we mentioned, has not been the main driver necessarily of the Australian dollar. In fact, the RBA have been talking more about rate cuts recently. So arguably this data from Australia may pull the Aussie back to ground. We've got the Bank of Canada meeting as well. The CAD has been stuck in a range, and that's despite a massive rally in oil prices, almost counter to what we just suggested, where other factors outside of the country have been driving the currency. Typically, there's quite a strong correlation between the Canadian dollar and oil, naturally because Canada's such a big exporter. That relationship's breaking down somewhat now that the US is such a huge exporter as well. When particularly look at the USD versus the CAD, still oil represents a much larger percentage of the Canadian economy, but obviously the US is a big exporter now as well. But to this point, the CAD has been stuck in a range despite oil rallying, so really CAD should be rallying when oil is. It hasn't been. That would, to me, as a price action signal, suggest that the loonie is looking quite soft. So a dovish Bank of Canada would support that thesis. The Bank of Japan meeting, the BOJ is a confusing one at the moment. Kuroda, the governor, is touting willingness to do more stimulus if necessary. So more stimulus is typically involves printing money. That would be negative for the yen, which is the money that they print in Japan, obviously. But realistically, versus those comments from Kuroda, the Bank of Japan actually need to cut their asset purchases under their QE program. That would be a positive for the yen. The reason they have to do that is just to get JGB yields back towards their target. They're of course targeting 10-year yields at around 0. And so because of the big drop in bond yields at the moment, they need to buy less bonds essentially to try and get that yield back to where they want it. Last data point is the US GDP. That's the big data point for the week as far as the US dollar. Trump may be complaining, as he was on Twitter recently, that lower rates and QE are needed to push up GDP, because notably GDP was up at 4%. Trump was heralding it as the great return of America, but it only lasted 1 quarter and it's been edging down since then. He's assigning the blame to the Fed in terms of raising interest rates over that period. But from a market's perspective, Goldilocks growth of around 2% is actually pretty ideal. It means the Fed's somewhat out of the picture, but still there's a decent economic backdrop to earn profits. So the last reading was 2.2% year over year. So we'll look at see how that compares on this latest reading. So the bigger context here as far as tech stocks is that these 3 shares I'm about to talk about make up a large contribution towards what happens in the Nasdaq 100 It's a very tech-heavy index, and there's only 100 companies within it, so the companies that do tend to have a large weighting. That index just hit a record high. So other factors aside, a fight to earn more yield, lower interest rates, and all the rest of it, investors look pretty happy with what's happening in terms of earnings in this sector. So let's start with Microsoft. Revenues last quarter were plus 12% year over year. That missed estimates. We're looking at 11% this quarter, so we're seeing a slight downdraft in revenues. Expected earnings per share around $1. That's up from 95 cents a year ago, but that year over year growth is starting to climb back somewhat. The key areas that we're looking for here in terms of looking at guidance for future quarters are the main drivers for why Microsoft has almost returned to being a growth stock rather than that kind of value stock it had been for a decade or so. It's obviously it's switched to the cloud, and it's that commercial cloud revenue, namely Office 365 Commercial, Azure, and Dynamics 365. Guidance, as I said, on all of these will be key looking forward and how investors overall judge the future growth prospects of Microsoft, which in terms of hard numbers has been deteriorating, although still on a great scheme of things, still very good numbers. Facebook shares, it had a pretty rough 2018, obviously hit record highs, but ended the year down quite significantly. The shares are up 35% this year, so just like we were talking about Nasdaq, Netflix last week, buying that December dip was obviously very worthwhile. These tech shares are pushing the mantle, and that's why the Nasdaq's at record highs. The other US indices haven't got there yet. So again, big expectations going into these results, so a higher bar to cross, if you like. That's interesting, given that earnings expectations have been lowered going into this. Talking about that, revenue growth is decelerating, but still impressive. Management have forecast 24 to 26% this quarter. Always with the social media companies, it's more about the user growth. So Facebook have switched towards talking about the users across their universe of apps. So it was 2.7 billion monthly active users in December, and the trend of late seems to have been that it's rising about 100 million every quarter. So we're ideally looking for a 2.8 billion this quarter. The other thing that could be a concern is expenses growth. Facebook has been very much beleaguered by privacy concerns, but given that it's almost a monopoly or duopoly at least in online advertising between Facebook and Google, they're still bringing in the revenue because companies don't really have any other choices in terms of digital advertising. So the business is still doing well, but they're having to spend more. Some of that's on security, some of that's on privacy, and quite frankly, a lot of that's on marketing too, just to defend its image to the greater public at large to make sure those users stick around. Amazon is pulled back a lot since its autumn peak, like these other tech shares, but still up, not year to date, but 30% year over year. So that's still pretty healthy, given that the S&P is up around 10% over that same period. So they guided lower on Q1 revenues, so that expectation's already been built in. So as it is most of the time, particularly with these growth stocks, it's more about their guidance for Q2. The main services that we look for is those Amazon Web Services, much like Microsoft, it's the cloud that's driving the growth. But also in terms of their retail business, just North American net income, that's really the big central driver for the company's growth. So earnings per share expected to grow around 40% year over year. Right, thank you very much for watching. Good luck with trading this week. And if you want to see these videos as soon as they're released, please follow myself and LCG on YouTube and social media.